Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
And, well, if you are hoping for a quiet Easter bank holiday weekend, you are completely out of luck.
Oh, absolutely. The regulatory weather system has completely different plans for us this weekend.
It really does. I mean, you look at the global news, right? NASA is grabbing all these headlines with its Artemis moon ambitions. But if you look at the UK mortgage market, it is heading rapidly in the exact opposite direction.
Yeah, coming crashing back down to earth, quite frankly.
Right. We have the unresolved conflict in the Middle East driving a very genuine energy crisis risk, which is sending this sudden shock right through the heart of domestic retail lending.
It's massive. And then on the operational side, you've got the Royal Mint making headlines with that startling cupro-nickel blunder.
Silver Britannia coins.
Yes. It honestly feels like an April Fool's joke, but it isn't. And of course, dominating the entire domestic agenda right now, the FCA has just dropped a massive, finalized £9.1 billion motor finance Easter egg right on the industry.
9.1 billion. It's a phenomenal convergence, really.
It is. What you're seeing as a retail banking professional is the collision of incredibly complex domestic regulatory execution with, well, unprecedented global macroeconomic volatility.
Exactly. So our mission for this deep dive is very clear. We are taking the FCA's finalized PS26 rules on motor finance redress, the Bank of England's H1 2026 systemic risk survey, and a whole raft of critical operational updates, and we are extracting the actionable board-level insights for you.
Because if you're a compliance officer, a risk manager, or a banking strategist, this is the map you need to navigate the weeks ahead.
Spot on. So let's start with that dominant story. The FCA has finally drawn a line under the Motor Finance Commission scandal. For months, the industry was braced for an estimated £11 billion bill.
Right, the worst case scenario.
Yeah. But the final policy, PS263, has brought that down to $9.1 billion. Which is a reduction, sure, but it still requires an incredibly complex operational rollout.
Oh, the sheer scale of it is staggering. But what is most fascinating to me here is the legal architecture the FCA has built to execute this.
The Section 404 powers?
Exactly. They're using their Section 404 powers under the Financial Services and Markets Act. But crucially, they haven't just created one giant redress pool. They have built this dual-track structure.
The two-scheme firewall. I actually love the mechanics of this. To use an analogy, it's like building a ship with completely watertight compartments.
That's a really good way to look at it.
Right. So Scheme 1 covers agreements from April 2007 through to March 2014. And then Scheme 2 covers April 2014 to November 2024.
And that split is vital. Because the pre-2014 era Scheme 1, well, that was regulated by the old Office of Fair Trading.
The OFT, yeah.
Right. And because of that, there's a much higher risk that firms might mount a high court challenge, essentially questioning the FCA's retroactive jurisdiction over those older agreements.
So by splitting this into two distinct schemes, the FCA has ensured that if Scheme 1 takes on water and gets bogged down in legal fights, Scheme 2 stays entirely afloat.
Exactly. The redress program for the post-2014 period can just proceed completely unencumbered. It's a highly defensive, incredibly pragmatic legal posture from the regulator.
It's smart. And that pragmatism extends to how they've calculated who actually gets a payout, doesn't it?
It does. They've refined the pool of eligible agreements down to 12.1 million. And the average payout is pegged at £829.
Okay, so how did they trim the pool down to that 12 million figure?
They applied very specific de minimis thresholds. So they excluded commissions of £120 or less for the pre-2014 scheme.
Right.
And £150 or less for the post-2014 scheme. The logic being that, well, commissions that small simply didn't materially influence the broker's behavior to the detriment of the consumer.
Chasing pennies costs more than the pennies are worth at that point?
Precisely. And they also entirely excluded 0% APR agreements.
Yeah.
I mean, if there was no interest charged on the loan, the commission structure didn't actually result in the consumer paying higher financing costs.
Okay, that makes logical sense. But let me stop you there, because the actual calculation of the redress, this is where I think compliance teams are going to pull their hair out.
Oh, without a doubt.
Because we have two distinct pathways. I understand the Johnson remedy. That's named after the Supreme Court precedent, and it applies to the most egregious high-risk cases.
Right. The roughly 90,000 agreements involving undisclosed tied arrangements or discretionary commissions over 50%.
Yeah. And for those, the remedy is totally punitive. It's a full refund of the commission paid, plus interest. But for the other 12 million agreements, the FCA is applying this hybrid remedy. If I'm sitting in a compliance department, how on earth am I supposed to calculate a hybrid of a consumer's theoretical loss and the actual permission paid?
It is mathematically intensive,
Yeah.
which is exactly why the implementation deadlines, the 30th of June 2026 for Scheme 2 and the 31st of August 2026 for Scheme 1, are actually quite tight when you consider the IT build required.
So how does the math work?
The FCA mandates an APR adjustment to calculate that loss. For Scheme 2, the newer agreements, firms must apply 17% APR adjustment. But for Scheme 1, the older ones, they apply a steeper 21% adjustment.
Wait, why the difference in the percentages? Why is the older one 21%?
It all comes down to the market dynamics of those different eras. In the earlier, less regulated years before 2014, the disparity between flat fee models and discretionary commission models was just much wider. Brokers had far more leeway to inflate interest rates to boost their own cut.
Ah, I see.
So the assumed financial harm to the consumer was structurally greater back then, which justifies that heavier 21% adjustment factor.
Okay, I follow the logic. But to protect firms from, overcompensating, there's also a triple cap on this hybrid remedy, right?
Yes, the redress cannot exceed the lowest of three figures. That's 90% of the commission plus interest, a fifth percentile market cost cap, or the actual total cost of the credit.
So no one gets a massive windfall. They just get restored to a fair position.
Exactly. But we do have to mention the compensatory interest rate applied to these payouts,
Right.
because the FCA has set a mandatory floor of 3%.
Which is a huge deal.
It is absolutely critical. For years following the financial crisis, the Bank of England base rate was sitting at virtually zero. If firms just applied the base rate, consumers would receive almost nothing in compensatory interest.
Right, but the real-world borrowing costs for consumers on the street, like credit cards, personal loans, they remain stubbornly high during that zero-rate era.
Spot on. So a 3% floor ensures consumers are fairly compensated for the real-world cost of being deprived of their money.
Okay, so ensuring 12 million letters and payouts are executed perfectly, it requires an absolute army of compliance and IP staff. And this brings us to a fascinating behavioral psychology point. How do you communicate this without losing millions of pounds to predatory third parties?
You mean the claims management companies, the CMCs?
Yes, they are salivating over this £9 billion pot.
It is a massive operational and reputational risk for the banks. CMCs typically try to take up to a 30% cut of consumer payouts.
30%. So on an average payout of £829, that is roughly £250 drained from the consumer just for a third party sending a template email.
An email the consumer could have just submitted to the bank themselves for free.
Which is why we're seeing an unprecedented joint regulatory task force mobilized right now. You have the FCA, the Solicitors Regulation Authority, the ICO, and the Advertising Standards Authority all moving as one unit.
And they've already taken down or forced amendments to 800 misleading CMC adverts.
That's huge. But the real frontline defense, at the end of the day, is the actual letter the bank sends to the customer. And the FCA ran a 10,000-person behavioral experiment on this that is just fascinating.
It really challenges conventional corporate thinking. They tested multiple versions of the redress notification letter. One version, which they dubbed supercharged, used high salience design. Bold colors, urgent calls to action, highly sales-driven language.
If you sit in a retail banking marketing department, supercharged copy is your bread and butter. You want urgency. You want high conversion rates.
Right.
But in the realm of regulatory redress, it was a total disaster. The data showed that the supercharged letters actually reduced consumer trust and lowered the intent to opt in.
Because consumers today are hyper-aware of fraud.
Exactly. A highly urgent, financially focused letter from a bank screaming about a guaranteed cash payout, it triggers their scam radar immediately. It looks too good to be true.
So the version that secured the highest engagement was titled Plain English Plus Barriers Removed. It was entirely devoid of marketing flair. It was highly official, slightly dull, and extremely specific.
It included the exact vehicle registration number, the date of the finance agreement, and explicit reassurances about FCA oversight.
Yeah, that dry, official tone is what actually proved authenticity. It convinced consumers to engage directly with the bank, cutting the CMC middlemen out entirely.
It's a brilliant lesson. When you're handling redress, you want to sound like an auditor, not a timeshare salesperson.
Yeah.
Boring is beautiful.
Truly.
But look, this operational burden of managing consumer communication and technology isn't just limited to motor finance. Let's look at the broader landscape of operational resilience because firms are really struggling to balance rapid growth with basic compliance right now. Take Revolut, for example.
A perfect case study in the tension between scaling a digital business and managing regulatory risk. Revolut just posted a phenomenal £1.1 billion profit,
Massive.
largely driven by their 70% fee-based revenue model. But in the very same week, Italy's competition authority handed them an €11.5 million fine.
And the reasons for that fine are entirely operational: misleading advertising regarding fee structures, and crucially, the automated freezing of customer accounts without sufficient human oversight.
It shows that you can have the slickest app interface in the world, but if your automated compliance algorithms are trapping innocent customers in a loop, the regulators will step in aggressively.
And this ties directly into another emerging operational headache we're seeing: the ChatGPT client. We have just passed the 10th anniversary of the Personal Savings Allowance, the PSA.
Let's unpack that because the numbers there are startling. The PSA threshold hasn't moved in a decade, but interest rates have obviously soared.
Right.
That has created a massive £4.7 billion fiscal drag. Millions of consumers who never previously paid tax on their savings interest are suddenly crossing the threshold and owing the tax man.
Yet, research shows 36% of consumers are completely unaware of their allowance limits.
And where do they turn when they don't understand their tax exposure? They ask artificial intelligence. The Consumer Group, which recently conducted a study and found that large language models are regularly advising consumers to breach their ISA limits or purchase entirely unnecessary products.
Now, I have to play devil's advocate here. If a customer asks a third-party chatbot a tax question, and the chatbot hallucinates a terrible answer, how is that the bank's fault? Why should a retail bank care what ChatGPT is telling its customers?
Because the consumer duty. The FCA has made it abundantly clear that firms cannot just shrug their shoulders at the information ecosystem.
I see.
If you know there is a systemic misunderstanding about tax liabilities, like this PSA fiscal drag, and, customers are turning to unreliable AI for answers, your consumer duty obligation means you must proactively communicate the correct information to them.
You have to guide them towards appropriate ISA migrations before they make a mistake. You can't just ignore the ChatGPT client.
Exactly. And that makes the FCA's upcoming 2026-27 work program very relevant. They have just confirmed their annual funding requirement at £788.9 million. A significant chunk of that is dedicated to launching a new AI sandbox and driving forward the payment systems regulator consolidation.
So the regulators are actively staffing up to police this new technological frontier.
They are. But at the same time, we are seeing some sensible streamlining. The Prudential Regulation Authority via CP 626 is officially removing the individual 15% high loan-to-income flow limit for mortgage lenders.
Well, that is a welcome relief. For years, banks were restricted in how many high loan-to-income mortgages they could issue. Removing that specific flow limit removes a massive, clunky compliance burden. It allows lenders slightly more agility in how they manage their overall books.
So they still need to maintain overall prudence, of course. And speaking of systemic safety nets, the PRA has also just confirmed the Management Expenses Levy Limit, the MELO, for the Financial Services Compensation Scheme. It is set at £113 million for 2026-27.
Which includes a vital £5 million unlevied reserve to allow rapid responses to firm failures. And despite lobbying from the sector, credit unions are still required to contribute to the revolving credit facility costs within that levy.
The PRA's logic there is that the facility supports the stability of the entire system, so everyone must chip in based on size. Proportionality is key.
Exactly. But before we move to the macro picture, I have to mention the Royal Mint's April Fool's style blunder again, because they accidentally struck a batch of what were supposed to be silver Britannia coins using a copper-nickel alloy.
It is the ultimate physical operational failure.
It really is, and it serves as a brilliant metaphor for retail banking right now. You can have the most sophisticated capital buffers in the world. You can have a £113 million FSCS safety net. But if your basic ground-level quality control fails, whether that's mis-selling car loans, automating account freezes, or minting the wrong metal, the reputational and financial damage is immediate. If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you. Now, we need to zoom out. We've talked about domestic levies, tech fines, and historic redress. But the Bank of England has just released its H1 2026 Systemic Risk Survey, and it reveals that the massive shocks reshaping the landscape are entirely outside of domestic control.
We have officially entered the era of geopolitical alpha. According to the survey, an all-time high of 95% of financial executives now view global instability as a top 5 systemic threat. It is the #1 risk across the board.
95%. And we are seeing that risk manifest in real time on the UK high street. The unresolved conflict in Iran and the broader Middle East isn't just a foreign policy issue. It is a direct, violent driver of retail bank asset quality. Look at the UK mortgage market whiplash we just experienced.
Right. The transmission mechanism from a geopolitical event to a domestic mortgage is incredibly rapid now. A shock in the Middle East immediately threatens global energy supply chains. That spikes oil prices, which immediately drives up inflation expectations.
And when inflation expectations rise, government bond yields surge.
Exactly. And because mortgage swap rates are closely tied to those bond yields, retail lenders have to react instantly.
The result was devastating for consumers. In just 1 month following the escalation of the Iran conflict, 1,283 mortgage products were yanked from the UK market. We saw 2-year fixed rates spike by 100 basis points, hitting 5.84%.
It's brutal. If you are a consumer rolling off an old fixed rate, you are suddenly looking at a £5,000 annual repayment spike,
Right.
purely because of geopolitical tensions thousands of miles away.
And the wholesale markets were equally turbulent. We saw hedge funds engaged in massive gilt repo deleveraging to the tune of £19 billion.
Yeah.
Let me just unpack gilt repo deleveraging for a second, because it sounds like dense jargon, but the reality is terrifying. Hedge funds borrow cash using UK government bonds gilts as collateral.
Right.
As the geopolitical shock drove up bond yields, the underlying value of those gilts plummeted. Suddenly, the lenders demanded more collateral, margin calls.
And to raise cash to meet those calls, the hedge funds had to frantically sell off assets, draining £19 billion of liquidity from the system in a blink. It's a textbook example of how a non-diversifiable geopolitical shock cascades straight down into domestic credit pricing. It is entirely interconnected.
Yeah.
And the Bank of England survey highlights that the geopolitical threat isn't just financial anymore. Physical security has now become a core operational resilience issue.
We saw this with the foiled bomb attack on the Bank of America branch in Paris, which authorities linked to the pro-Iranian group HAYI. That wasn't just a security scare, it was a major operational disruption.
It forced staff at Goldman Sachs and Citigroup in the region to immediately shift to remote working as a precautionary measure.
We have spent years treating cyber attacks as the primary external threat to banking operations, and cyber remains high in the survey. But physical geopolitical spillover is now a tangible daily risk to market infrastructure.
It completely forces risk managers to rethink their business continuity planning. Meanwhile, while geopolitics dominates, artificial intelligence is officially broken into the top tier of systemic fears. 32% of executives put AI in their top 5 risks.
And this isn't just the fear of AI giving bad let's advice to consumers. The concerns are highly structural. There is deep anxiety over stretched equity valuations. To use an analogy, the market has built a massive valuation skyscraper on a very narrow foundation.
Huge amounts of capital.
Billions in debt financing have flowed into U.S. technology companies focused on AI. If those investments don't yield the expected productivity miracles, that valuation skyscraper wobbles. A sharp correction there would trigger drastically tighter funding conditions globally, which crushes the ability of UK corporates at ground level to raise capital.
Furthermore, they are flagging job market disruption. If AI implementation leads to rapid systemic unemployment in the white-collar sector, that directly undermines retail credit quality and mortgage performance.
Because if your borrowers lose their jobs to an algorithm, your loan book goes into default.
Exactly. When I look at this risk survey, it feels like risk managers are finally waking up from fighting the last war. Everyone spent the last 3 years sweating over inflation. Now, inflation concern has essentially disappeared from the register. It has dropped to just 2%.
Meanwhile, domestic UK political risk has jumped 12 points to 16%.
It is a profound shift in the risk hierarchy. The survey perfectly captures a financial system in transition. The threats that dismantle product pricing today are not domestic inflation prints. They are geopolitical conflicts and the fragile valuations of AI hyperscalers.
Which brings us to the ultimate synthesis of this deep dive. The era of predictable, isolated, domestic retail banking is well and truly over. Whether a bank is trying to manage the data reconciliation for a £9.1 billion historic motor finance scheme, dealing with the fallout of an automated compliance algorithm freezing accounts, or trying to reprice 1,000 mortgage products overnight because of an energy shock, the core requirement is the same. Extreme strategic agility and ironclad operational resilience are the only ways to survive.
You cannot manage a modern bank by just looking at your domestic ledger anymore. You have to understand the global transmission mechanisms.
Which leaves us with a final, provocative thought for you to ponder this week. The Bank of England currently maintains the UK counter-cyclical capital buffer, the CCCIB, at 2%. The purpose of that buffer is to protect the banking system against traditional economic downturns.
Oh, right.
But if geopolitical alpha and sudden artificial intelligence market corrections are now the primary overarching threats to the financial system, are traditional capital buffers actually measuring and mitigating the right risks anymore? Can a 2% capital buffer realistically protect a balance sheet from an AI-driven market crash or a global supply chain freeze triggered by conflict? It is a question every bank board should be asking themselves at their next meeting.
It certainly makes you wonder if our regulatory weather instruments are properly calibrated for the types of storms we're actually facing today.
An excellent point to end on. If the FCA's multi-billion-pound Easter egg and the Royal Mint's Cupro-nickel blunder show us anything, it is that the heavy regulatory weather is here to stay. That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.